Okay, so we're going to dive into how to pull out that equity to use for your second home purchase, or third, or fourth, or fifth, or beyond. But I wanted to chat a bit about the benefits of commercial real estate investing, because we ended our first segment on that. So there's two categories of commercial real estate: multi-unit residences, or commercial buildings like office buildings, warehouses, and retail spaces. I know we've had a whole segment on investments and different stuff before, but this segment is different than we've done before. So bringing to you. So properties with 5 or more rental units designed for living spaces can be considered commercial real estate. This means that investors who choose to buy condos, duplexes, and quadruplexes are considered commercial property. In contrast, office buildings, warehouses, and retail spaces are the most common commercial real estate buildings, and they typically host a business of some sort. Long-term leases. This is a huge benefit to commercial real estate, so they're known to have longer leases than residential. Residential properties typically have either month-to-month, or maybe a 6-month lease, or a 12-month lease, whereas commercial property leases can last years. In fact, some commercial properties can typically be 5 or even 10-year leases. So commercial real estate's long-term leases can help an investor protect their investment for a relatively long period of time. And it's a bit easier because there's not as much upkeep, because the actual tenant usually takes care of everything. So it's pretty hands-off being a commercial investor once you get a tenant in place, and if there's any improvements that you had to do. So it doesn't have as much turnover as residential units either, and higher ROI. So what is ROI? It's a return on investment, another acronym. So it's a ratio between net income and investment. So this ratio is used to determine how much money an investor receives after all the necessary payments have been deducted. So this is determined by a simple equation. So ROI, investment gains, investment cost minus cost, and then the cost of investment. So you look at all of that. So there's cash flow, there's ROI, there's different things you look at. So investors have found that traditionally commercial real estate has the highest returns over residential. So commercial properties typically have an annual return of the purchase price between 6 and 12%. And this is higher because typically residential properties in a balanced market, which we're usually in, is around in between 2 to 6% equity growth. So that is something also to think about. And then tax benefits. So a commercial real estate investor could save a lot of money on taxes compared to those who have invested in residential properties. This is because commercial investors can take advantage of double net leases or triple net leases. And usually you see those triple net leases because they are the best, in my opinion. So a double net lease and a triple net lease are when a tenant rents an entire commercial property. In a double net lease, tenants pay for the rent and 2 other incidentals, typically the property taxes and insurance on the building. In a triple net lease, tenants are responsible for all costs except any structural repairs. So this means the landlords don't need to pay property taxes on their commercial property. Everything's being taken care of within that lease. And the triple net changes year to year depending on how property taxes and building insurance fluctuates. So you got your base net rent, and then you've got your triple net, which is covering all those costs, and that changes year to year. So what is home equity? Okay, let's get into that. How am I going to get money to pay for these investments? We'll use your home equity. Home equity is the value of your homeowner's interest in your home. When a buyer takes out a mortgage loan from a financial institution to pay off their home, they and their lender both have vested interest in the property. Typically, lenders have the primary interest in a home after it's been first bought, because maybe you only put 5% down. This is because, over amount of time, though, when you're paying towards your mortgage after the interest, it shifts. But it can take a long time if you're not paying more than your basic mortgage payments. But the financing option. So as you build up your equity, as you pay down your mortgage in the years to come, depending on how much you put down, you do build that up. And especially in the last few years, it's built up so much. there are many ways that homeowners can tap into that home equity and buy a second, third, or fourth property. So let's talk about all of them or some of them. Home equity loans, home equity line of credit, and reserve mortgages can help. Reverse mortgages can help you leverage with your primary residence and get the cash you need to start investing. So first, let's talk about home equity line of credit. This is my favorite for the typical average person. A home equity line of credit, which is a HELOC, is a credit line that homeowners can access by leveraging your home's equity. So in Canada, owners are restricted to borrowing up to 65% of the appraised value of their house. So to determine how much your HELOC is, take the value of your home and multiply it by 80%, subtract the outstanding balance of your mortgage loan, and the final figure will be how much equity that you have to use. But, just talk with your financial institution who you have your mortgage through and let them figure that out for you if you're confused at all. But while home equity lines of credits are very useful ways to finance buying a second property, there are some limitations to them. There's always, give and takes with everything, the good and the bad. Homeowners can only access a HELOC when you have built up at least 20% equity in your home. So talking about how hopefully your equity's grown if you only put 5% down, look into it, though, because the rate, everything's gone up. You hopefully would have that. So you'll also need to have good credit. Obviously, we talked about that a few episodes ago, about watching your credit score, making sure you build up your credit and keep an eye on it. So if you should have good credit and you don't, find out why. If you meet the criteria to access your HELOC, there are many benefits in using it to find another property. I mean, the more you pay back your mortgage loan, the more you could borrow as well. And it's a line of credit, so you don't pay on it unless you're actually using it. So it's perfect to buy that, even a vacation property, a rental property. It's a great way. So buy an investment property with a home equity loan. Let's talk about that. So a home equity loan, also known as a second mortgage, so that's what it is on your title. It's much similar to the HELOC, but it's an actual loan. But you could borrow up to 80% of the appraised market value of your primary home, minus the balance due on the mortgage, of course. The primary difference between a second mortgage and a HELOC is that the second mortgage acts like a typical mortgage, as I mentioned, that second mortgage on your title. So hence the name, second mortgage. They usually have fixed rates as well, and come with a lump sum of cash that a person needs to pay back. So here's your second mortgage, here's the lump of cash, and you are paying on it from the day you borrow it. That's why I like the home equity lines of credit better, because you only pay the interest on it. You only pay that when you use it instead of a lump sum. But if you need a lump sum for some reason, this is a great way of doing that as well. How about a reverse mortgage for the second property? So, of course, this is a really good way you have to be 55 years or older and a homeowner, of course. But this is a good, for a lot of people who have fixed incomes but want that second property or want a bit of a future retirement plan, and you don't have the cash, this could be a way of doing it. So a reverse mortgage, sometimes called an equity release, is a loan that allows you to get money from your home equity without having to sell your property. So homeowners can get up to 55% of the appraised value of your property from the reverse mortgage, making it way easier to buy other properties. So reverse mortgages, they do not need to be paid back until the homeowner decides to buy another primary residence or moves out or passes away. They also don't owe tax on the money borrowed. This makes this a great option for those older individuals on those fixed incomes I mentioned, because they can delay loan payments. So there's a lot of good things to talk to your mortgage provider about that. So refinancing your primary property is the last way of pulling out some equity I wanted to talk about. So home equity is a source of funds that can help finance a real estate investment. So I believe we've talked about 4 different ways of doing it here. And so refinancing your house, which a lot of people have chosen to do that in this last year because the interest rates have gone down so much. If you didn't have a huge prepayment penalty, and even if some did, back in 2007, I believe, I did this on one of my properties, and I refinanced it because I was paying such high interest rates. I had a $6,000, so it wasn't that bad of a prepayment penalty. Some are in like 30,000 and 26,000, and like there's higher ones if you get out of it earlier. But I paid that amount. But after 3 months of paying, I started making money. Like, so I was like, I could pay 6,000 now because in 3 months I'll start raking it in. So so refinancing your property if the interest rates are a lot lower, or if you want to go into that flexible mortgage with only 3 months interest payment only, which is the variable rate mortgages. So again, talk with an advisor on that to see what's best for you, but maybe refinancing your property is the way to go for you. So take the time to look into all those options. I know I spitted them out pretty quick here. But how are we doing on time, Curtis?
Oh, we're getting a little close to the end here.
Oh, good, because you know what? That's where I wanted to end it, because there's so much more to say. But if anybody has any questions, they can just contact me directly, and I can give them a whole brochure and package on it and talk with them about their specific needs, along with their financial advisor and their mortgage provider. We could be a great team and a real estate lawyer to help you build your real estate wealth. And so then we should end the show with a quote of the week.
I would hope so. It's kind of become our thing.
Yes. And this one's from Henry Ford. Failure is simply the opportunity to begin again, this time more intelligently.
Well, if there was something those early car manufacturers learned, there was a lot of early failures, and they learned from that. He knew what he was talking about.
It's true, and he kept on going on, and he didn't stop. He got back on that horse. So I love that, and that's perfect for this show to say, you know what, don't be scared to do your first investment. Just take the necessary steps. Take that first step and continue taking the steps, and you'll be successful.
Alrighty, well, if people want more information or want to contact you about everything we've talked about today, where can they go?
MicheleCummins.ca.
And make plans to join us again next week when once again we will talk real estate in order to unlock your real estate potential on a show where real estate is maximized. Thanks for listening.